You might have heard of depreciation before. But what is it? Property, plant, and equipment, or PPE. A special category of prepaid expenses. These are used to produce and sell products and services. Examples of PPE include equipment, furniture, vehicle, and building. All PPE, with a general exemption of land, eventually wear out or decline in value and usefulness. When PPEs wear out due to use and passage of time, the decline in value should be recorded as an expense in the income statement over the asset's useful life. The useful life of a PPE is also called the benefit period or life expectancy of the asset. The useful life is an estimate of when an asset is expected to function until it becomes unuseful. Another way to think about depreciation is that it is the process of allocating the costs of these long-term assets over their expected useful lives. In short, depreciation represents how much of the PPE has been used up. If you bought a piece of equipment worth $1,000 that will last for 5 years, will it be fair to charge all the cost to the first-year revenue? Consistent with the matching principle, the cost should be spread out over the 5 years when the equipment is expected to generate revenue. This means each year's revenue should receive an equivalent of $200 share from the cost of the equipment. Make sense? The account depreciation expense, or simply depreciation, is used to record the amount of depreciation that is to be recorded in the income statement. Depreciation expense is recorded with an adjusting entry similar to that of the prepaid expenses. Increase the expense account and decrease the asset account. As an example, Peak Company bought a computer worth $900 in cash on December 1, 20x1. The useful life of the computer is determined to be 2 years. On December 1, the account balance of the computer bought was $900 in cash. The initial journal entry recorded is debit computer equipment and credit cash of 45,000 pesos. On December 31, depreciation should be recorded on the equipment. Peak uses a method called straight-line depreciation, in which the value of the asset is allocated equally over its useful life. Thus, to compute for the depreciation expense, 1/24, or 1 month over the 2-year span, multiplied by the cost of the asset, which is $900, equals $37.50. This amount will be recorded as a depreciation expense for the month of December. The adjusting entry to record the depreciation of the computer equipment on December 31, 20x1 is debit depreciation expense and credit accumulated depreciation for the amount of $37.50. What? Yup. Accumulated depreciation. The accumulated depreciation is an asset account, but with a normal credit balance. This account is also known as a contra asset account. Contra asset accounts are accounts that are associated with an account but it has the opposite normal balance. Since it has the opposite normal balance, it reduces the associated accounts balance. Instead of crediting the computer equipment account, accumulated depreciation is used in adjusting entry to offset the value of that asset. For instance, Peak Company's accumulated depreciation computer equipment account will be deducted to the computer equipment account in the statement of financial position. Accumulated depreciation is simply the total depreciation expense for all prior periods. For instance, the depreciation expense of Peak on December 31, 20X1 is $37.50. The accumulated depreciation will also be $37.50. Since this is the first time to record the depreciation. On January 31, 20X2, the depreciation expense for this month will be $37.50. Same as the last month's depreciation expense since the straight line depreciation is used. But the accumulated depreciation will be $75. Derived from the depreciation expense in December and the depreciation expense for January. Going back to the adjusting entry of Peak Company, the contra account accumulated depreciation is used because it causes the asset's book value to decline over time. The book value, or the net amount, is the difference between the cost of the asset and the accumulated depreciation as illustrated earlier. So on December 31, 20X1, the book value of the computer equipment would amount $862.50. What if the equipment has an estimated salvage or scrap value of $300 at the end of its useful life? What would be the depreciation expense on December 31, 20X1? The depreciation expense on December will amount to $25, derived using this formula of the straight line depreciation. The cost of the asset less the salvage value divided by its useful life. What is the salvage or scrap value anyway? The salvage value is the estimated book value of an asset after the depreciation is complete. Meaning, this is what a company expects to receive for the asset at the end of its useful life. Look at this illustration. If the equipment of Peak Company has its useful life ended, the computer equipment will still have an estimated value of $300. When compared to an asset without a salvage value, the accumulated depreciation will offset the total amount of that asset. Up next, adjustment for the allowance for doubtful accounts.